Hey everyone, Couch Investor here, back with another earnings video. So let's talk about Roku. At the time of making this video, the stock is down close to 20% after hours. So that city note saying that we might get a 20% upside surprise was maybe half correct. They just forgot to put the minus before the 20. So yeah, down by a lot. Why is that? Even though it beat on earnings per share and on revenue, but outlook was a bit weaker and expenses are up by over 20% year over year, which is obviously, well, not great right now when growth is slowing down. Your expenses are up 70% year over year. A bit of an issue, but we're going to go over all of this report, and then obviously at the end, is it time to sell or is it time to sit on your hands and watch it play out? Obviously, do share your thoughts down in the comments below as well. If you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And if you want to support me and this channel, maybe do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So these were the key metrics. And you know what? Overall, it could have been much worse. Let me explain. So active accounts grew 16% year over year, and it grew a little bit quarter over quarter as well. We're now at 65.4 million. Streaming hours actually increased again quarter over quarter, because as you can see here in Q2, it decreased quarter over quarter, but now it's up sequentially and also year over year. Nice little bump there, 21%. And then obviously ARPU, well, basically flat quarter over quarter. It's up 10% year over year, but we knew this was going to happen. Slowdown in ad spending. That's also why you can see here platform revenue increased just 15% year over year. Total net revenue grew 12% year over year to $761 million. But then if we scroll down, we can see that platform revenue decreased quarter over quarter, but again, to be expected in the current macro environment. And player revenue, which to be honest, let's be honest, in the future of this company, it's not that significant, but okay, that's basically flat quarter over quarter. We've had a huge decrease back in Q4 to Q1. Now it's flat, so I'll take it as a semi-positive, but it is down 7% year over year. As for gross profit, that's down quarter over quarter and down 1% year over year. Player gross profit is up actually 20% year over year. So I guess, again, that's a little positive. As for total gross margin, we are a bit up quarter over quarter, but we're down 6.7 percentage points year over year. Again, to be expected. But this is the issue, right? You are still growing a little bit, but then if you look at expenses, total operating expenses, it's up 71% year over year, with the huge increase in sales and marketing, 91% increase year over year. I mean, of course, these are things that, well, you can see the effect of it right now, but these are things, the actions have been taken months and months ago. So we'd like to see what happens in the coming quarters. Obviously, they do touch on that in the outlook segment, so we're going to have a look at that in just a bit. But yeah, it's with every company that we've looked at so far. Expenses have increased by a lot. It's basically out of control. Growth has slowed down, so that's why you have this big disconnect. And then, of course, it affects income from operation, adjusted EBITDA and adjusted EBITDA margin down significantly year over year. Now, when it comes to outlook, they expect total net revenue of $800 million, so an increase quarter over quarter, but it's a bit down from the consensus number. Total gross profit, $325 million. Net income, a loss of $245 million. And adjusted EBITDA, also a loss there, $135 million. Now, with regards to the adjusted EBITDA for Q4, this consists of compensation of approximately $105 million, depreciation and amortization, and other net adjustments of approximately $5 million. Now, stock-based compensation have also increased year over year. As you can see right here, it basically doubled, right? Stock-based compensation basically doubled for this quarter, and then overall 9 months ended. So year to date, it's almost doubled. Now a bit more context maybe on everything that's happened during this quarter. So again, the Roku OS was the #1 selling smart TV OS in the United States, and they continue to build scale in the markets outside the US. They're expanding their global Roku TV program to Germany with TCL and Metz, and to Australia with TCL as well. And with regards to Mexico, because that's also a country that they're always mentioning during the earnings report, so they're the #2 selling smart TV OS in Mexico. And in October, they launched the Roku channel in Mexico as well. The Roku channel is the free channel, but it is ad supported. Now remember, we talked about it a couple of weeks ago with regards to the smart home products. So they give us a bit more context right here. So their smart home launch included cameras, video doorbells, plugs, and lighting, along with the Roku smart home mobile app for iOS and Android. So they launched all of that. It's exclusively available at Walmart, America's #1 retailer in nearly 3,500 locations, where, and this is a pretty important metric, Roku is the #1 smart home brand by shelf space. And by the way, if you look at this picture right here, yes, it is hardware, but as you can see here, it is also a subscription-based model. So this might increase the margins there. And this is basically how it will work. You can control everything through your phone. And then if you're watching something on your Roku TV and somebody's at your doorbell, you'll get a pop-up just like this. So pretty easy. And this really resembles the partnership that they had with Walmart with regards to shoppable products, shoppable ads. Pops up on your TV. All you have to do is click on OK, and you've just bought something through your TV. And now I want to touch on monetization, because I do feel that, of course, there is some bad news right now, but it's not just bad news for Roku. It's bad news for the whole advertising market. Each and every company that we've covered so far was hit because of that, was hit because of a slowdown in ad spending. Of course, that will come back at one point or another, right? We don't know when, but eventually it will come back. Not only will it come back, it will probably come back stronger as streaming takes a larger part, a larger chunk of that ad budget. And as they explain right here, they continue to increase their share of advertising spend as traditional TV audiences decline. Their Q3 platform revenue increased 15% year over year to $617 million in an environment that saw significant pressure in the traditional TV ad scatter market, which was down 38% year over year, as you can see on the graph right here. With continued economic uncertainty, they expect ongoing ad scatter declines for both traditional TV and connected TV to continue until at least next year. But if we compare, then Roku is outperforming. And now let's talk about Outlook and conclude this video. So they say here, as they enter the holiday season, they expect the macro environment to further pressure consumer discretionary spend and degrade advertising budgets, especially in the TV scatter market, as we've seen above. We expect these conditions to be temporary, but it is difficult to predict when they will stabilize or rebound. We therefore anticipate Q4 player revenue and platform revenue to be lower year over year. Okay, not great. Could also explain why the stock is down close to 20% after hours. Then they talk a bit about operating expenses, and to me that's the most important part. So their significant Q3 OPEX year-over-year growth was largely the result of robust hiring in late 2021 and early 2022, which also means that you will see a huge increase probably in Q4. So they believe that, well, this happens when the economy was emerging out of pandemic-related disruptions and they accelerated investments that they had previously deferred. They started taking steps to significantly slow the rate of hiring and other OPEX growth in late Q2. However, it will take a few more quarters for this year-over-year OPEX growth rate to normalize, probably Q1, Q2 of next year. They will continue to slow headcount and OPEX growth in response to the macro environment while continuing to make disciplined investments in their strategic product that will increase both the market penetration of their platform and long-term customer value. And they end by saying that the broad secular shift to streaming remains fully intact, and it is for this reason that they continue to invest and innovate. Their significant scale, a direct relationship with tens of millions of consumers, and an ad proposition that delivers measurable return on investment to marketers. In short, they expect Roku to be in a stronger position than ever when we'll come out of this difficult macro environment. And so to conclude, I will say this. Now is probably not really the time to sell your shares unless you have something better to do with that money, if you have a position, that is. Is it a good time to start buying? Maybe 5 years from now, in hindsight, yes, this might have been the bottom. Could always go lower, right? We thought $50-something was the bottom. Guess what? We're now 20% lower. But overall, I think Roku as a company is still in a very, very good position. Unfortunately, right now, the macro environment is what it is. Unfortunately, ad spend is slowing down, and that's obviously affecting a company like Roku that basically, well, the majority of its business is ads focused. Let's see what happens with the trade desk, but it might be affected as well, probably will be affected as well. What am I doing? Right now, I'm not adding, I'm not selling either. I want to see how this story develops in the coming quarters. I'm okay. If this is the bottom, fine. Then the value of my shares will go up eventually. I'm not willing to add more money currently to my position because there are still some risks, and I'm okay by waiting to see if the market becomes a bit better in Q4. Obviously, do share your thoughts down in the comments below. Of course, seeing minus 20% after hours is not always nice, but look at how the company performs right now, in the past, and let's wait for the coming quarters to better evaluate how the company is doing in maybe a better macro environment. Because we've been following this company through the pandemic, which was amazing for Roku, and then coming out of the pandemic, everything changed super quickly, so it's now the complete opposite. Let's see how they perform in a normal market, normal world. So that will be it for this video. If you enjoy this type of videos, do leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I'll see you all in the next one. Bye bye.